Now look, I want you to picture this. It's late June 2025. America has a brand new tax on the books. Everybody's calling it the revenge tax. And it's pointed at foreign investors, anybody whose money touches American soil from a country Washington thinks plays dirty. It's maybe a few weeks old. Then the world's richest nations start to grumble. The G7 pushes back. And within about a week, the Treasury Secretary picks up the phone, tells Congress to kill it. And they do. Gone. And then Wall Street throws a party, complete with ethically sourced caviar and cocaine that was probably tax deductible. Now you'd think a government this hungry for money never met a tax it didn't like. That once it gets a hand in a pocket, it doesn't like to pull it back out. That is not what happened. They yanked this one in a week. For foreigners. For the money that could fight back. But the revenge tax dying isn't the story. It's what it's teaching every state house in the country. A version of this same idea that's pointed at somebody else. You. One aimed at regular people who just want to sell the house, hand over the keys, and move somewhere that makes sense. You see, there's a habit forming underneath it all. A move your government is making more and more every time money tries to head for the door. There's a name for what they're building. They call it an exit tax. So if you own a home and you're thinking of selling, don't sell yet. Not until I show you what to look for. Not until I show you the one question to ask first. Because if you did everything right, you paid off the house, you played by the rules, you ate your vegetables, went without when you had to, you probably told yourself the same quiet thing. Hey, if it ever gets bad enough, we'll just sell. We'll take our money and move somewhere that makes more financial sense. The house was your escape pod. Well, here's what should stop you cold. They're building a trap door into that escape pod, and it's spreading across a dozen states right now, this year, and it's just getting started. That same revenge tax move, tax the money on its way out the door. The states now, they're running it on you. Like New Jersey, for example. And I'll probably get to your state too here in a minute, but let's start here. New Jersey doesn't actually call it an exit tax. They call it GITREP withholding, which sounds less like a tax and more like the error code on a busted ATM. Here's what it does. If you move out of New Jersey and sell your old house, the title company is required to skim a cut at the closing table before you touch a dime. So on an $800,000 sale, that's about $16,000 held by the state, interest-free, for a year or more. You get most of it back when you file, eventually, but you got hoops to jump through. You start by filing a non-resident return you'd otherwise never touch the next tax year, and then you wait. And the second you ask for it back with no other New Jersey income, which is everybody who actually moved, the state fires off a notice demanding you prove you really left before they'll cut you that check. You front them 16 grand, interest free, and then you have to audition to get your own money back. And they've quietly done it since 2004. But here's the scary part. Every other state can copy it with one quiet line in the law. And many of them are doing just that, making it so you can't even record the sale of your own house until the state gets its cut first. Look at Massachusetts. They don't call it an exit tax either. They call it the Fair Share Amendment, a name so wholesome it sounds like a PBS pledge drive. It's a 4% surtax on income over $1 million in a single year, sold as a Millionaires Tax. But the state's own revenue department confirms it. That surtax hits the gain on your home sale. So a couple who bought in Cambridge decades ago and sells to retire, once their gain clears the federal exclusion, that one-time sale can shove them over the line and cost them tens of thousands extra. It doesn't charge you at the gate, it charges you at the tax return. And it's worked too well. Massachusetts has pulled in $5.7 billion from it, roughly double what they projected. Now, when the model prints money like that, the model spreads all the way across the country to Washington state. And guess what? They don't call it an exit tax either. Noticing a pattern? Yeah, they ripped it straight from Massachusetts pages and called it the Millionaires Tax also. And here's why this one matters. Washington had no income tax for almost a century. The last attempt, it got struck down back in 1932. That was the whole reason people were moving there. Well, this past March, the governor signed a 9.9% income tax on income over $1 million. The seal that held for 94 years just broke in one signature. And it reaches non-residents on Washington source income too. So leaving the state doesn't fully unhook you. And what responsible tax conversation would exclude California? Well, surprise, they don't call it an exit tax either. They're working on something called the Billionaires Tax Act, On paper, it's a 1 times 5% hit on people worth over $1 billion, about 200 people. And you hear that and think, good, let them pay. That's exactly what you're supposed to think. That's what they want you to think. This is the same mechanism that started the federal income tax, by the way. We'll call it the Billionaires Tax so we can get it easily passed, because everyone hates billionaires, right? Right. But buried in it is language that rewrites California's constitution and hands the legislature power to amend this thing to further its purposes. Those are scary words, further its purposes. You see, once that door is cracked, they don't have to come ask you again. They just argue that dropping the threshold from $1 billion to $100 million furthers the purpose. Then to 10 million, then to 1, then to you. And don't think it won't. I mean, if you pay federal income tax today, that's proof it will eventually hit you. And here's the brutal exit tax part. It just qualified for the November ballot, and the measuring date is January 1st of this year, already behind us. So even if your plan is to exit before the vote, they're getting their cut. You can't outrun a date in the past. And the union backing it admitted the measuring date was built so people couldn't dodge it by moving. They said the quiet part out loud. It's designed to be inescapable. But wait, New York, same story, same tax, different name. Why don't any of them call it an exit tax when it's assessed when you exit? Well, because estate tax modernization sounds way better, doesn't it? Like a zoning board adding sidewalks. Shoot, even I'd probably vote for something like that. The new mayor is pushing Albany to cut the estate tax exemption almost 90%, from $7.35 million down to $750,000, and to triple the top rate to 50%. Exiting the state isn't enough for them. They want to tax your exit from this earth. So that's 5 states, and you'd be forgiven for thinking, okay, those 5 states, I don't live in any of them, I'm in the clear, I'm fine. Well, you're not fine. Those 5 are just the loud ones, the ones with a ballot measure or a press conference. The quiet version is already law in a dozen states you'd never suspect. The same cut at the closing table when you sell the house you already moved out of? Well, California takes over 3% of the sale price. For everybody. This isn't a billionaire tax, this is for everybody. Maryland takes 8%. Oregon, Pennsylvania, Maine, Mississippi, the Carolinas, Georgia, all of them, right now, today. No ballot, no press conference, no town hall, just a line in the fine print that wakes up the day you try to leave. It's a toll on the way out, even when you do get some change back later in some cases. And the newest one tells you exactly where this is all headed. This past April, Maine slipped a brand new 2% tax on high earners into a budget bill. And the guy up there who had just sold his business he'd spent 30 years building, he called it what it is, a one-time exit tax. And he said, that makes it harder to hand the keys to a younger Mainer. His words, a man who just sold his life's work, looking at the bill, calling it an exit tax to its face. So 5 states out loud, a dozen more quiet, and Rhode Island, Virginia, and a handful of others drafting their versions as we speak. But here's the tell that should bother you most. Notice where the fight moved. It's drifting off the ballot, where you could actually vote it down, and into budget bills, where you never get a vote at all. That's not a trend cooling off. That's a stampede learning to move quieter. And that, 5 built, a dozen running, more coming, the whole thing speeding up and going underground, that is what just getting started actually looks like. Oh, well fine, I'll just leave the country. If that's what you're thinking, hand back the passport, take my money and go? Yeah, they thought of that one too. At the federal level, they didn't even bother with the disguise. They actually call it what it is. They call it the exit tax, right there on the books, in black and white. And it's the meanest version of all. The day before you hand back your citizenship, the government pretends you sold everything you own. The house, the stock, the retirement account, your grandmother's antique credenza, all of it, sold on paper in one imaginary instant. Then they tax you on that pretend sale. They call it a deemed sale. And deemed, that's a word that only ever brings bad news. Nobody's ever been deemed the sexiest man alive. It's always your chicken has been deemed medically unsafe. So how do you get around this thing? Well, 3 steps. And the order matters more than anything I'm about to say. Step 1, find out the number. Before you do anything, find out what your state charges to walk out the door. Search your state plus non-resident withholding, or your state plus exit tax. Some states, they take nothing. Some skim a couple percent, a few hit you for 7% or more. It's tough to plan a move around a toll you don't even know it's there, so 30 minutes. Do it before you so much as call a realtor. Step 2, Decide if you even care. Maybe you don't. Maybe you run the number and it's small and it's insignificant, or you're not going anywhere anyway. Well, then that's good news. There's nothing to do here. Skip to the end and watch the next video. Not every problem is your problem. Step 3. If you are going to move and you don't want to pay the toll, the order is everything. And these are just some things I've been thinking about. What if you sell the house first, rent for a bit, then move out? Would that work? Probably, I think so, because the toll only catches non-residents selling the old place. And if you're still living there on closing day, then you're a resident. Sell first, move second. Or what if you changed your state residency first and then sold? Would that work? But I think you just accelerate the process really and confirm you moved away. But if you've got another idea, share it below. Because I'm in Nevada. We don't have it here yet. So I haven't given it much thought on how to work around it. I'm sure there are some smart people who could figure this out though. But whatever you do, check with your attorney or your CPA before making any moves. Please don't take any advice from here. I'm just a guy who's recognized a pattern, and I'm recognizing that it's spreading, it's accelerating and escalating. And that's why I pulled this video out here for you to watch next. Because these patterns, they are everywhere. Like these 7 system failures that by themselves may easily be explained away and be like inconsequential. But when you connect them, you can see how they're working together to quietly take back everything you have ever worked for. So check it out. Protect what's yours. God loves you, and so do I. Take care.